Private equity and credit have run on a comfortable assumption that money can flow in easily, and when things get tight, liquidity is always there. Today, that assumption is facing a major reality check. Partners Group has capped redemptions on its $8.6 billion global value fund after withdrawal requests hit nearly 10% in the second quarter. Here is what actually happened. Investors in the Partners Group Global Value Fund tried to pull 9.8% of the fund's capital in the second quarter of 2026. Under the fund's rules, Partners Group automatically triggered a 5% quarterly redemption cap. That means investors who wanted their money back are only getting about 62% of what they asked for, with the rest of the requests canceled rather than rolled over. This isn't an isolated incident. In the private credit space, Cliffwater capped redemptions at 5% on its $31 billion flagship corporate lending fund after investors asked to withdraw 17% of their shares. At the same time, Bank of America is warning that 3 of the largest private business development companies, or BDCs, could face downgrades to junk status within 2 quarters if their current 5% redemption outflows continue. Credit pressure is also showing up in public markets. High-yield junk bonds are flashing a technical warning signal. The 50-day moving average on major junk bond exchange-traded funds has crossed below the 200-day moving average, a pattern often called a death cross. When speculative debt starts to sell off while the stock market sits near record highs, it usually tells us that institutional investors are quietly reducing risk. A big part of the credit and rate pressure comes from energy prices. Crude oil is trading near $95 a barrel and is close to testing a major resistance level at $100. If oil breaks above $100, analysts expect it could target $120 to $150. That would reignite inflation worries and make it even harder for the Federal Reserve to consider cutting interest rates. Meanwhile, the stock market is showing signs of exhaustion. The S&P 500 recently hit new all-time highs, but has started to pull back. Technical analysts are watching 748.75 on the SPY ETF as the first major support level. This level lines up with previous resistance, the 20-day simple moving average, and key Fibonacci levels. If we look under the hood, the market's internals show a steady flow of sell volume. The S&P 500 futures market profile is showing a distinct B-shaped liquidation pattern. This is an important detail. It indicates that the market is falling because buyers are closing out their positions and taking profits, rather than because aggressive new short sellers are entering the market. Even with credit and index pullbacks, the tech sector is trying to hold its ground. Micron Technology has guided to a massive 81% gross margin for the upcoming quarter. That would be the highest margin in decades, up from about 75% in the prior quarter, driven by tight supply for high-bandwidth memory chips used in artificial intelligence servers. But memory has always been a highly cyclical business. While bulls argue that AI demand has permanently changed the industry, bears warn that gross margins will eventually revert to their historical 40% average. If they do, Micron's earnings could drop significantly, illustrating the massive gap between peak AI optimism and normalized hardware economics. How is consumer spending holding up through all of this? One explanation is that consumption is being funded by home equity and stock gains, rather than traditional wage growth. Many U.S. households are mortgage-free, which shields them from high interest rates and leaves them with significant discretionary cash. But this wealth effect spending also means inflation remains sticky. We are also seeing massive capital calls drain liquidity from the broader stock market. Alphabet announced a historic $80 billion equity capital raise, including a $10 billion investment from Berkshire Hathaway to fund its AI data centers. At the same time, funds are rotating out of speculative tech names to prepare for the upcoming $1.75 trillion SpaceX listing. The watch list for the days ahead is straightforward. Watch the private market redemption gates at Partners Group and Cliffwater. Check the high-yield corporate bond momentum, follow the SPY support levels, and track Micron's margins. These indicators will tell us if the credit pinch is stabilizing or spreading. The takeaway today is that the market's margin for error has shrunk. High interest rates are exposing cracks in private credit and corporate bonds, while mega-cap equity sales are draining cash. In this environment, investing is less about following the broad growth trade and more about finding companies with real cash flow and clean balance sheets.